We're getting headlines out of India. I'm going to the terminal here right now, folks, to get them. Mr. Patel is speaking. And, David, I think they're really, really interesting headlines. Mr. Patel is talking about a few months of turbulence, talking about the beginning of currency wars. He's saying the world possibly at the beginning of currency wars. And Mr. Patel says, quote, "I have to run a tight ship." Boy, does that sound like some form of EM austerity. Is that what we're going to see into the next 18 months? Is some kind of EM austerity reaction?
Well, I think it's straightforward that if U.S. monetary conditions are tightening, then EM monetary conditions have to tighten, because otherwise there'll be capital outflows from emerging economies and exchange rates will continue to weaken, and that will be destabilizing for financial stability and inflation expectations. So from that point of view, it's, what he's saying is kind of straightforward. The issue of currency wars has become particularly interesting now because of what's happening to the renminbi. In the last month, aside from the Turkish lira, the only emerging economy exchange rate that's actually depreciated is the renminbi. And the Central Bank of China seems to be quite confident that the exchange rate can weaken without unleashing an unwelcome outflow of capital. That was the concern in 2015, 2016. In other words, that if the renminbi depreciated, that would feed through to Chinese exchange rate expectations and therefore fuel an increased demand for dollars. Because of the measures that the Chinese took in late 2016 and early 2017 to lock down the capital account, to restrict capital outflows, the PBOC seems to have more flexibility at the moment to let the exchange rate weaken without shooting itself in the foot by creating an environment in which China's capital account becomes unstable.